I think gold is likely to trade between 3,000 and 6,000 for a decade. And the best of the performance of gold is over, most notably silver. Remember what happens. Prices go exponentially. It shifts the whole metric. I think it's stuck in a long range frame. Something really, really bad, some kind of really bad debasement or inflation has to happen. But to me, typically, this is part of that signal that happens after we get to that cycle of post-inflation deflation. This could be like 1929 when it just kept running and running and running, then collapsed in the last quarter of the year. Could do that. What was the sentiment for Bitcoin at the beginning of 2025 versus gold? Actually, before Mr. Trump got elected, I was at a conference. I pointed out how I was tilting towards gold away from Bitcoin. And one of these people, actually older than me, said, I feel sorry for you.
10,000 gold or $10,000 Bitcoin, what's more likely?
10,000 Bitcoin.
Oil back down to $60 or $120?
60.
A 10-year Treasury yield, what's more likely, 4% or 5%?
3.9.
Will the Fed funds rate go down this year, or stay the same, or up?
And it's going to go with the stock market. Down with the stock market.
Inflation at 3.5 by the end of the year, or 3?
2.
Is gold short, potential short on your list?
Yes, I do think, well, it's different to say short gold and silver. Gold's an ancient store of value, but what's happened with the velocity of the rally we saw in gold and silver this year, typically will put in a peak for decades. So we could make a new high, but I think gold is likely to trade between 3,000 and 6,000 for a decade. And one key thing I want to remind people, I was on the sell side of that trade of gold, being bullish gold in 2000 up to 2011. And remember how great it looked in 2013 after it rallied and then hovered around 1,500 for like 2 years and then collapsed? We could do that. But I think what it's going to do is going to drive people crazy for a long time. The best of the performance of gold is over, most notably silver. Remember what happens. Prices go exponentially. It shifts the whole metric. And everybody will point out the fundamentals, but that's always what happens in peaks. And I have to put on my relative value prudent investor hat. And I've been bullish gold for decades, particularly after 21, 22, and 23 when it couldn't get above 2000. It finally did in 2024, but now it's just run too far. And it's just the lessons of when price goes up that much and it gives you a gift to lighten up, you're supposed to do that.
The danger often begins when an asset starts looking safest right after its fastest move. As Mike McGlone points out here, gold can remain structurally strong while still becoming tactically overextended after a vertical rally. Investors sometimes confuse a long-term store of value with a market that cannot pause, even though history showed in 2011 and again in 2013 that momentum can disappear for years. When price outruns conviction, even strong fundamentals stop protecting weak entries. Next, Mike McGlone discusses why sideways markets can become more frustrating than outright declines for precious metals investors.
I think it's stuck in a long range frame. Something really, really bad, some kind of really bad debasement or inflation has to happen. But to me, typically, this is part of that signal that happens after we get to that cycle of post-inflation deflation.
Seems like a lot of things have lost steam. So the software sector's down year to date about 23%, that's the IGV. Gold, like you said, is just trailing sideways. So is silver. Oil has lost steam since early April. We talked about that extensively. Bitcoin is just underperforming, like you mentioned. The only thing that's doing really well in terms of big indices is the S&P and the NASDAQ as well. I'm not talking about soybeans or other commodities, but how would you describe this phase?
Well, we're in this phase that I think towards the end of a bull cycle. Now, I've been saying that for a while. People get it. The signals are quite clear, but it's not going to end until it ends. And the next key theme, the next major catalyst for recession is some wealth reversion. We get to 2.4 times GDP. The lessons in life are, unless you're very young and you have time to diversify, you don't want to be overweight any market that's that expensive. And being in Florida, what it does is it sucks everybody in and makes everybody think they're smart. It keeps going up until finally it stops. So that's I think what's going to happen in stock markets basically is what happened in the crypto market back in October. Remember, it just took one day and it killed the sentiment. It's been going down since. Now we're bouncing in a bear market, but the signals are there. And remember, who really peaked the crypto market was Mr. Trump. And I think he potentially can do that in stock market too. All this bravado and cheerleading can make prices and go too high, make people make the wrong decisions for the wrong reasons at the wrong levels. And then it puts an enduring peak. So I view this as near the end. And it could, who knows how long it could last. This could be like 1929 when it just kept running and running and running and then collapsed in the last quarter of the year. Could do that. But either way, I'd still say it's a year to be overweight treasuries and pick your spots to be responsive selling and maybe responsive buying. The only thing I really found attractive to buy so far is that long bond one gets near 5%.
You're overweight treasuries in a year where people are expecting inflation to go up. Doesn't the 10-year track inflation expectations?
Exactly. Well, that's exactly like Benjamin Disraeli says, but we generally anticipate seldom occurs.
A market can look healthy on the surface, while leadership quietly gets narrower underneath. As Mike McGlone points out here, software weakness, flat metals, softer oil, and weaker crypto are not normal signs beneath an apparently strong index tape. When only the S&P 500 and Nasdaq keep carrying sentiment, investors can mistake concentration for resilience, especially near 2.4 times GDP valuation extremes. That is often where portfolios feel safest, just before liquidity starts choosing fewer winners. Next, Mike McGlone talks about why defensive positioning can matter more than chasing the final stretch of a late cycle rally.
What was the sentiment for Bitcoin at the beginning of 2025 versus gold? So David, it was one of these key signals I love getting anecdotally. At the end of 2024, it was actually before Mr. Trump got elected, I was at a conference. I pointed out how I was tilting towards gold away from Bitcoin. And one of these people, actually older than me, said, I feel sorry for you. And I'm getting that same sentiment in precious metals just a few months ago. And now in the stock market, it just won't do anything but go up. But these are signals when you're supposed to just be prudent and stay away and be careful. And even in gold, and that's why I say that 5% long bond is wonderful, but these are how things happen. Just key theme here is when we do get a little bit of normalization in the stock market, so that 10% correction at the beginning of the year, that was almost 25% of GDP. If you get just a 10% drop or 10% drop that stays down, that's going to be the signal. That's going to be, everything's going to follow it in terms of deflation, but we're not there yet. It hasn't happened. It's not going to happen ever. And that means at some point it will. I think it's going to be this year. And so far, it's only April.
Crowd confidence usually becomes loudest right before risk starts getting mispriced. As Mike McGlone points out here, when investors openly pity defensive positioning, that sentiment can become a warning instead of a contradiction. A sustained 10% equity decline after the opening months of 2026 would not just hurt stocks. It could reset expectations across commodities, bonds, and speculative assets at once. Markets often ignore fragility until the first real break forces everyone to suddenly notice the same data. Next, Mike McGlone unravels why investor psychology can reveal more than price action during major turning points.
All this stuff to be bullish, every metal, almost all of them, on a macro picture, including platinum and palladium, all of them, stock market has to go up.
Are you an equities analyst now then? Is that
unfortunately
what this is? Because you're I say this facetiously because you're a commodities analyst, but like you rightly pointed out, the correlation is basically 1 between the S&P, copper, and gold for the last couple of months. And look at this V-shaped recovery here. All assets going up and down together. So who's following what? Because if everything's just following the stock market, then you have to be focused on where the S&P is going.
So that's what I am, a commodity strategist, but I focus on what matters for the market. And I like to say to people, if you're bullish metals, you got to be bullish the stock market. Sorry, that's just the way things are. When you get to 2.4 times GDP, that's the way life is. It's the highest since 1929 in the US, 1989 in Japan. That's just the way life is. It's how it's happening. Gold has kind of figured that out a little bit, but gold got too expensive. But that's just a fact. So here's another fact is some people sometimes claim, oh, you're too technical. And sometimes they claim, oh, you're too focused on the stock market. It's only because I focus on what matters for that commodity at a time. So right now, the most significant factor is what I mentioned for crude oils, what I mentioned earlier is we have the leader of the world's largest energy producer and net exporter of crude oil and natural gas who wants lower energy prices, and there's election in November. That's paramount. It's part of the reason this invasion started a few months ago, the U.S.-Iran war. Get it over with, get it cleaned up before we get to midterms.
We have to figure out the direction of the stock market. And you're looking at oil at $90 a barrel and the stock market still at all-time highs. actually surpassing all-time highs. Can you write off the theory that higher oil prices are going to be detrimental for EPS earnings for the next quarter?
Well, that's the key thing. Earnings are phenomenal. They've lagged a little bit. They've curved down a little, came down a little bit, but it's all predicated on stock market has to keep going up. It's all related. So I'm impressed how the markets look past crude oil up to 90, up to 100 and backed off. But it's seen what I've seen. It's seen that elasticity I write about all the time. Crude oil, if it continues higher, it'll break everything, including itself. It's its own worst enemy. But it's just like me. You look forward to where that puck's going.
The market keeps pretending asset classes still trade independently when correlations say otherwise. As Mike McGlone points out here, metals, crude, and equities have been moving together closely enough that ignoring the S&P can distort the entire commodity outlook. When valuations sit near levels last seen before 1929, earnings strength alone cannot justify every risk staying elevated indefinitely. Investors who separate macro from sector positioning may miss how one stress market can quickly infect another. Next, Mike McGlone discusses why oil may become the pressure point that exposes broader market complacency.
December crude oil around 77 is probably where we're going to be or lower by the time we get the midterms or by the time these expire. But the bottom line is the stock market's not going to go down ever until it finally starts going down. That's why I have to look at it. At some point it will. But main thing I've been wrong on, but there's also been the key themes that are really warning us. Bitcoin breaking down and crypto's breaking down, peaking last year and still just basically hovering, way underperforming the stock market on a volatility adjusted basis, way underperforming. So very much of the signal there. And what gold did last year by breaking out like that is telling you there's a major signals that all the indications for the stock market peak are there. And the key theme I look at, David, is volatility is just too low for what the volatility you're seeing in gold and precious metals. So I look at this year as my key theme remains stock market volatility will go up. Still been wrong on that. Hide from the market, hide in treasuries, and just stay away and pick your spot. So I look at, anytime that long bond can get near 5%, it cannot stay above. I think it's unlikely to stay above. I think there'll be duration buyers there.
Sometimes the warning is not a crash, but how calm everyone stays before one. As Mike McGlone points out here, falling crypto leadership and stronger signals from gold are flashing caution, even while stock volatility remains unusually compressed. When the VIX stays quiet as cross-asset stress builds, investors can become overexposed without realizing the market is already rotating beneath them. Treasury yields near 5% can start looking less defensive and more like selective opportunity during that kind of disconnect. Next, Mike McGlone talks about why suppressed volatility can be the most dangerous signal in this market.
I looked at the key theme you mentioned, copper as a potential prudent short around 6. If it can stay above 6, great. But if it breaks down, stock market breaks down, it's going to go down a lot harder. Silver, I knew initially above 100. It's a prudent potential short. Now that's dropped only about 25% from that level. Bitcoin near 100,000. It got to 96,000. Now it's dropped about 25%. It's bouncing a little bit, yes. But those are levels that I think are the leading indicators that are only going to stabilize if the stock market goes up. And if stock market goes down or they lead the way down, they're going to go down at the higher volatility ratio they typically do, which means much more. So I stick with that theme. Right now, it's a wonderful environment. Remember, it's only April. And the key theme is there's extreme complacency in the stock market. Now, a lot of people are hedging, but that's the problem sometimes is when you get hedged and we got the VIX up to 30, it's great. Some of your long vol positions kick in, but hedging is difficult to manage. I like to just say sometimes it's just get out, hang out in treasuries and wait for opportunities.
Maybe the stock market's pricing in the fact that the Iran war doesn't really matter. That's one interpretation. Does it matter for you?
Some of the loudest warning signals are coming from assets investors still treat as background noise. As Mike McGlone points out here, copper, silver, and Bitcoin have already started weakening at levels that usually reveal stress before the broader equity market admits it. A 25% pullback in speculative leaders, while the S&P remains calm, often shows complacency is still overpowering caution. Even with the VIX touching 30, many portfolios are still leaning on hedges instead of reducing exposure outright. Next, Mike McGlone unravels why commodity weakness may be signaling more than traders currently want to acknowledge.
Oh, absolutely. From a crude oil standpoint, I think what's happening though is I think it's going to end up, and I think the market's looking at it as a bit of the battle of the bulge in World War II. Yes, that was a bit of an aberration, and then it came back. Mr. Trump will get this figured out. It's basically his war now. I mean, it's a lot worse than I think he initially thought. When the first invasion happened and the leadership was killed, I thought that would be it. They'd capitulate, not close the strait. But, just the fact that he's making statements that they don't have a Navy, but they've been able to close the strait as people are looking over at him, this is a problem. And then what's happening with the Poles? They're getting crushed. What's he going to do about that? He needs energy prices lower. How's that going to happen, David? So this is very political, but it's also very fundamental. I just point out this is just an absolute opportunity for landman to bring on more supply and continue to do what they've been doing for at least a decade, and that's pressuring all commodities with this excess surplus of energy and food production in the U.S. that needs to be exported. And I certainly mean crude oil, natural gas, corn, soybeans, and wheat.
Oil markets often react to politics long before politicians admit they are involved. As Mike McGlone points out here, crude is no longer just responding to supply shocks, but to the pressure of election optics and public confidence. When leaders need lower energy prices heading into November, policy can quietly become part of the pricing model investors rarely discuss openly. That can distort how traders interpret every move in oil, natural gas, and even agricultural exports. Next, Mike McGlone discusses why political pressure may be shaping commodity markets more than traditional fundamentals.
Just going back to oil for a minute, do you think that we can bake in $1 per barrel higher permanently? Because that's the toll that the Iranians are charging for ships going through the Strait of Hormuz, and it looks like the Americans are conceding to that for now.
Nothing, virtually no rallies in commodities, hardly ever permanent. So why is cocoa and orange juice some of the worst performing assets and commodities this year? Because they went up too much. It's just the way it works in commodities. It's the elasticity, the thing we started on this program. The bull market elasticity is the most significant theme in commodities. Even gold's too expensive now. And the key thing to remember is you have supply, demand, and price on the same model. When price shifts exponentially, supply goes up, demand goes down, prices adjust. Crude oil right now is breaking things. And that excess of supply in the U.S. is just ballooning. It takes time. I mean, it takes a year or so. But the average cost of production in the U.S. is around $55 a barrel. On the screen, you see 93. You go out to DC, you see 77. That's why everything is backwardated. Not just crude oil, but soybeans and corn and natural gas, or they're flat because these producers can bring in more every day.
Commodity rallies often look permanent right before basic economics quietly turns against them. As Mike McGlone points out here, once prices accelerate too far above production costs, supply eventually rises and demand naturally starts pulling back. With US oil production near a $55 average cost, while spot prices hover much higher, producers have a strong incentive to keep adding barrels. Many investors focus only on geopolitical headlines and miss how quickly price itself can become the force that ends the rally. Next, Mike McGlone talks about why price elasticity may matter more than fear-driven headlines.
We have major motivation from this administration. And this is even in the past, it wasn't as motivated, but they still brought in the supply. And price right now is favorable to sell forward in the curve, bring on supply, and at the same time, demand's getting crushed. And one key theme about that, Dave, is when you see the price of gasoline jump 50% in such a short period of time, and price of diesel jump almost 75% to almost near the all-time highs. That's the grease of the economy. That's just going to shut down the consumer and consumption, and it's going to increase the supply.
Somebody tells me, hey, David, I want to switch my gas car to an electric car because oil is at $90 a barrel WTI. Higher for Brent.
Right.
What do I tell them?
Rest of the world's doing it. I did it in 2000 and my Chevy Volt's 2014 model. And key theme is I'm enjoying this, the fact that the U.S. has 100% tariffs on some of these very cheap, very good, very efficient EVs coming out of China. It points out what's happening with the paradigm shift in the world. Look what's happening with automakers in Germany and Japan and the economy in Germany. They are just getting crushed. The whole rest of the world are just saying, thank you very much. I'll take some of those BYDs.
The real energy story may be how expensive fuel is quietly speeding up its own replacement. As Mike McGlone points out here, a 50% jump in gasoline and a 75% surge in diesel can push consumers toward alternatives faster than policymakers expect. High oil can temporarily support producers, but it can also accelerate electric vehicle adoption and pressure legacy automakers already struggling globally. Investors watching only crude prices may miss the larger capital shift already forming underneath transportation markets. Next, Mike McGlone shows why higher oil could unintentionally strengthen the long-term EV transition.
My colleagues I speak to overseas, I was like, yeah, you see them everywhere. I've seen them on the road. So you can't see them here. We have the tariffs to protect our domestic industry, but don't underestimate the overwhelming technology that gets a boost when prices jump like this. There's different models, but just the fact that a lot of the rest of the world can get same kind of vehicle that I bought 12 years ago. I have a plug-in hybrid. It's a Chevy Volt, and it's basically you can get that from $10,000 to $20,000, and it has 3 times the range that my vehicle has, and it costs a lot less than I paid 12 years ago. That's where the technology is going. That's where maybe silver is going up a lot and copper is going a lot, but things like crude oil are just becoming like going the way of whale oil.
We're going to do a 30-second speed round now, Mike. 10,000 gold or $10,000 Bitcoin, what's more likely?
10,000 Bitcoin.
Okay. Oil back down to $60 or $120?
60.
The 10-year Treasury yield, 4.3%. What's more likely, 4% or 5%?
3.9.
3.9. Will the Fed funds rate go down this year, or stay the same, or up?
And it's going to go with the stock market. Down with the stock market and not change much. The stock market keeps going up.
Inflation at 3.5 by the end of the year, or 3?
2.
Wow. Okay. There's a headline. And finally, would you be in overweight tech stocks or underweight right now?
Underweight virtually every risk asset and overweight treasuries.
Technology shifts rarely feel disruptive until old industries suddenly look expensive and outdated. As Mike McGlone points out here, global buyers are already seeing cheaper electric vehicles with better range than models sold just a decade ago. That matters because rising energy prices can accelerate demand for metals like silver and copper, while slowly weakening long-term oil demand. Many investors still treat that transition as distant, even though consumer behavior overseas is already moving faster than expected.